Welcome to the final section of Cycle 7 on the month-end close and financial reporting. You have learned how the close runs, the controls that protect it, and the responsibilities that drive it. Now you will learn how to apply all of that as an advisor. The close process reveals the quality of every upstream cycle, and your judgment is what turns a pile of numbers into trustworthy financial statements. Over the next several minutes, you will work through a practical 5-step advisory approach. The ways the close differs by company type, 6 realistic case scenarios, the red flags that should stop you, and the improvements that fix them. Why does an advisor need a structured method instead of intuition? Because the close touches every account, and you cannot inspect everything in the time you have. By the end of this section, you will be able to apply a repeatable 5-step advisory approach to any client at any close cycle. You will adapt your focus across business models, from private companies to public accelerated filers. You will diagnose 6 of the highest-risk scenarios you will actually encounter in practice. You will recognize the red flags that signal process failure or enforcement risk, and you will prioritize the improvements that deliver the most value first. Let us begin with the method itself. How do you assess a close you have never seen before? You use a 5-step approach that works for any United States client at any close cycle. Here is the key insight that makes it powerful. The close process reveals the quality of the upstream accounting cycle operations. A chaotic close almost always indicates problems in cycles 1 through 6 that the close is absorbing. So when you walk in, you are not just looking at the close, you are reading the health of the whole accounting function. The 5 steps move from the close calendar and velocity, through journal entry controls, the reconciliation package, accounting estimates, and finally filing readiness. Let us take them one at a time. Where do you start? With the close calendar and close velocity. Ask for the calendar and the last 6 months of actual close dates, then ask 2 questions. Is there a formal calendar with named owners? And what is the real velocity, meaning the days from period end to management accounts? If the close takes more than 10 business days, that is a significant operational problem. It usually means upstream cycles are not finishing on time, reconciliations are not being done during the period, or there is simply no formal close management. This is why your first advisory deliverable is often a formal close calendar with timelines that are realistic but aggressive. Velocity is the single most revealing metric you can measure. Why focus so hard on journal entries? Because that is where management override hides. Ask for the manual journal entry register for the most recent period and review it carefully. Look for entries without a second approver, entries posted after period end into a closed period, and entries by people who do not normally post, such as the Chief Financial Officer or Chief Executive Officer posting directly. Watch for large round number entries and entries to unusual account combinations, like revenue posted to an expense account. Any one of these is a red flag. For public companies, this matters even more, because the Public Company Accounting Oversight Board auditors target manual journal entry controls as one of their highest frequency inspection findings. This is where small problems become serious ones. How do you test the integrity of the balance sheet without checking every account? You sample where errors concentrate. Ask to see the signed reconciliation for 3 accounts, the largest accrued liabilities account, the intercompany receivable or payable if one applies, and the deferred revenue account. For each, ask whether there is a proper reconciliation rather than just a schedule attached to the ledger account. Is it signed by both a preparer and a reviewer? Are there unresolved differences, and is it current? Here is the pattern you will see again and again. Many companies have clean reconciliations for cash and accounts receivable, but not for accrued liabilities or deferred revenue. Those are precisely the accounts where close errors concentrate, so that is exactly where you look. Why do estimates deserve their own step? Because they are where judgment becomes earnings management. Review the 3 largest accounting estimates, typically the allowance for doubtful accounts, the inventory obsolescence reserve, and the warranty or legal reserve, or whichever three are most material for the client. For each, ask whether there is a documented methodology and whether it has changed from the prior period. If it changed, was it treated and disclosed as a change in accounting estimate? Then ask the hardest question. Is there management pressure to use a more favorable estimate than the methodology supports? Pressure to reduce reserves heading into year-end is a significant earnings management risk, and recognizing it early is one of the most valuable things you can do for a client. How do you know a company is actually ready to file? For Securities and Exchange Commission registrants, confirm the filing deadline and compare it to the expected close completion date. Is there sufficient buffer, meaning at least 5 business days, for legal review of the MD&A and for validating the XBRL tagging? Then confirm the going concern assessment is documented and has been updated through the expected financial statement issuance date. Here is the rule worth remembering. Any company with significant debt maturities within 12 months, negative cash flows, or covenant headroom below 10% should have a robust going concern documentation package, regardless of whether substantial doubt actually exists. Readiness is about the buffer and the documentation, not optimism. Does the close work the same way everywhere? The stages do, but the pressures do not. The close runs the same 24 stages for every company, yet the velocity requirements, audit requirements, and risk concentrations differ significantly by company type. For private companies, close velocity is the primary metric, since many close slowly because reconciliations are done annually rather than monthly. Private equity-backed companies face the highest velocity pressure and an earnings risk around earnings before interest, taxes, depreciation, and amortization add-backs. Public accelerated filers work backward from hard filing deadlines. Multi-entity groups live or die on intercompany reconciliation. And estimate-heavy companies, in industries like insurance, banking, and technology, face the most audit scrutiny and the highest earnings management risk. Match your focus to the model. Picture this situation. At year-end, the Chief Financial Officer posts an undocumented journal entry reversing $2 million of accrued liabilities, which increases income by the same $2 million. What is the risk? This is a classic management override and one of the most common forms of financial statement fraud. So what is your advisory response? The external auditor must be informed immediately of any discovered management override. Under Public Company Accounting Oversight Board Auditing Standard 2401, the auditor is required to perform unpredictable tests targeting override. The controller should have a policy requiring approval of all topside entries and independent controller review of anything posted by the Chief Financial Officer or Chief Executive Officer. In a public company, this requires audit committee notification and potentially an internal investigation. Consider 2 operational breakdowns. In Case B, a close takes 17 business days before the board package is issued. That signals structural problems. Reconciliations done after the close, upstream cycles running late, no calendar. Your response is to map the process in detail, find the 3 longest critical path tasks, and ask whether each delay is a data, capacity, or process issue. Then build a calendar working backward from a day 7 target. In Case C, intercompany balances are out by $1.4 million at consolidation, which blocks the close entirely. The fix is the intercompany reconciliation policy. Post all intercompany transactions at a single agreed exchange rate. Apply cutoffs simultaneously at every entity. Make the payable side responsible for initiating the reconciliation, and use a clearing account so imbalances are visible daily. Now consider 2 disclosure failures. In Case D, the company has a $15 million revolving credit facility expiring in 8 months with no refinancing underway. Yet no going concern assessment was performed because management assumed refinancing would happen. Accounting Standards Codification 205-40 requires a formal assessment regardless of management's confidence. documenting the condition, management's plans, the likelihood of success, and the conclusion. In Case E, a $3 million revenue overstatement surfaces in the prior year. Apply the Staff Accounting Bulletin 108 dual method test, checking both the rollover and iron curtain views. If material under either, restate. For registrants, that means filing a Form 8K under Item 4.02, restating the affected filings and re-auditing. Proactive correction before the audit is always preferable. Here is one of the most dangerous scenarios. The MD&A in the public filing says the business is growing strongly and revenue is tracking ahead of plan. But the internal board package shows revenue 12% below plan with a deteriorating outlook. What is the risk? This is a direct inconsistency between internal reporting and the public filing, and it is a potential Securities and Exchange Commission enforcement issue, because the MD&A must accurately reflect management's assessment. Your advisory response is to implement an MD and a consistency check. Before any draft goes to legal review, compare the key statements against the most recent board or management package. Any statement that internal reporting could contradict needs either a legitimate explanation of why the perspective differs or revision to reflect reality. How do you turn diagnosis into action? Start with the red flags. Manual journal entries posted by the Chief Financial Officer or Chief Executive Officer without a second approver signal override risk. Undocumented topside entries, annual rather than monthly reconciliations, closes over 10 business days, unreconciled intercompany balances, and an undocumented going concern assessment all point to process failure or enforcement risk. Then move to the highest priority improvements. Build a formal close calendar with named owners. Implement monthly reconciliations with preparer and reviewer sign-off. Require independent approval for manual journal entries and Chief Financial Officer review of all topside entries. And confirm MD and a consistency before legal review. These first improvements target the two most common public company accounting oversight board inspection findings. Let us bring it all together. You now have a 5-step advisory approach that works for any client. Read the calendar and velocity, assess journal entry controls, inspect the reconciliation package, evaluate the estimates, and confirm filing readiness and going concern. You can match your focus to the business model in front of you, recognize the cases that demand immediate escalation, such as management override and MD and inconsistency, and prioritize the improvements that fix the highest impact failures first. With this section, you have completed the full journey from close to report across Cycle 7. You have seen how a disciplined close produces financial statements that investors, lenders, and regulators can trust. Thank you for completing this section on advisory application.